All right, today is May 19th, and recording this quick video from my apartment. Just wanted to highlight some things that are happening economically that have been catching my eye and giving me some things to start thinking about as we go into these next couple of weeks. Because some of the things are concerning and I think they're worth addressing and just starting to prepare for, right? Not in a sense that like something crazy is about to happen or anything like that. It just seems like one of those more kind of quote unquote pause moments, right? And I would just kind of explain my reasoning. Typically when I have time, I like to dive into a lot of articles, regarding the economy, seeing what's happening with the stock market and things like that. And lately I've just been noticing just some very interesting trends that I think are worth keeping track of, right? And there's a lot of things, but first off, right now, as you may have noticed, treasury yields are starting to jump rather quickly, especially as of this week, right? You have the 30-year treasury jumping north of 5%. Right, you have the 10-year treasury, which of course is tied to things like the mortgage rates and so on, jumping up past 4.5%. And by every metric, right, these are very concerning levels, simply just because, right, that just entails that there is a increasing concern from bond investors about, things such as inflation and as well as our country's ability to pay its debts back, right? Because, for bond investors, obviously they're going to go where returns are the best, right? And the safest usually. And so when you have a situation, right, where inflation is starting to rise due to things, for example, like what's happening in the Strait of Hormuz, the reality of the matter is, in order for these bond investors to continually feel like they get a better rate of return by investing in U.S. Treasuries, then they need an interest rate to support that, right? Because from their view, when they see inflation starting to increase fairly rapidly, right, due to things like the price of oil going up and the situation happening now with fertilizers and how that's going to impact the cost of foods, right? As we enter like planting season and so on, you quickly start to enter a situation where, the U.S. is going to have to start paying up in order for bond investors to, still take on this debt, right? And unfortunately, that also will impact other assets like mortgages, right? Because mortgages, mortgage rates, right, are basically a premium that is charged due to the fact that U.S. Treasuries are just a safer investment. And so in order for investors to, buy those mortgage-backed securities, because banks don't hold on to these mortgages when they create them, that interest rate, right, on those mortgages will also go up. Because it's either, right, again, from the bond investor's point of view, I could either, invest in, again, the safest instrument there is, right, which is U.S. Treasuries at, whatever it is now, 4.5% for the 10-year or 5%, or I could invest in mortgages, but if I'm going to do that, I have to worry about things like prepayment risk, payment risk, right? For example, somebody doesn't pay their mortgage on time and those kind of things that can eat into returns over time. So I don't want to go too deep down that rabbit hole, but basically the way I'm just viewing this right now is, this inflation situation is about to get rapidly out of control unless something happens, with this Iran war situation, and also the U.S. starts taking their fiscal issues more seriously. Because, going into these repeated $2 trillion deficits is insane, in my opinion, and very much unsustainable. So going on from that note, speaking on the idea of just, higher interest rates as well, another place that will also be impacted by this is the AI trade as well, right? Because as interest rates rise, for things like the 10-year treasuries and such, then that also will turn into a lift on interest rates for things like, the AI capex, right? Like taking out more debt, as we know, like Meta, Google, Amazon, like these guys are spending hundreds of billions of dollars, right? And now increasingly starting to take on more debt to fund these AI expansions with these data centers and such. And so now you're going to be looking at a situation where, the cost to fund those things is also going to start to increase as well, right? Which can, unfortunately, dampen their financials as well, because it can expand as aggressively, right? So that's another thing I'm keeping an eye on, because a lot of the momentum we've seen in the stock market over the past several months has been due to things happening in the AI space, right? The semiconductors, all these, insane earning reports coming out, right? And so now you're looking very much at a situation where, for the first time in a while, there could be some serious news that starts to dampen this momentum. And in my opinion, slowly but surely start to encourage profit taking because of these insane runs that have happened. I could very much see a situation where people start to say, hey, I don't know where this is all going. Let me start to just, secure some profits, right? And I think that's completely natural behavior, and I expect that to happen more. Again, barring some type of massive change happening very soon, right? So that's another thing I'm keeping my eyes on. In terms of just consumer sentiment as well, that seems to be kind of here nor there, and I think it makes sense in my opinion. The only place I guess there's only two situations I see that really changing. And the first is if there is some type of massive unemployment situation that happens, right? Then I could see a case where, things really start to pull back just because of a lack of confidence in the economy. But I think right now things are holding on because we're still kind of in that low fire environment. Even though, right, there are signs of cracks, especially when they got companies like Meta who just laid off 8,000 people. Starbucks just opened up another office in Nashville and they're laying off in Seattle, right? You've had Amazon with all these cuts and more to come. And so it's creating a lot of uncertainty, right? Because that translates to less jobs, which translates into less tax revenue, less demand for services. And, it just becomes a growing death spiral. And I think what becomes a concern is if that eventually starts to spill over from other industries, but that remains to be seen. And then, of course, you have the Strait of Hormuz situation, right? Things are escalating, things are then de-escalating. Supposedly Trump said this, Iran said that. You don't really know where all this is going to go, right? And unfortunately, it's creating a lot of uncertainty in things like, gas prices and oil supplies, as you can see. And we're increasingly relying more on reserve stockpiles. But again, question I ask there is what starts to happen when we run low on those things, right? And there's a fertilizer situation, right? There's also a lot of, resources for fertilizer and just fertilizer in general that comes out of the Strait of Hormuz. And that is also going through constraints, right? And because of that, farmers can't get a hold of as much fertilizer as they normally would, or at least at a reasonable rate, right? And we know how the agriculture industry can just rely on thin margins as it is. And so you have to wonder now, well, if these guys can't get a hold of the fertilizer they need, well, then now what starts to happen with the output of crops, right? And, what do we do? What gets substituted out? What price increases can we expect, right, on just regular groceries on top of everything else that's already been increasing, with groceries, right? And so that's yet another thing, right? And it's tough because you don't really know how bad any of this stuff is going to get because we have to just kind of wait and see, right? And then so I guess now it really begets the question of, well, what do we do here from an investing standpoint, right? because at my level, if you've been following me, you know that like I really don't, it's not nothing, right? But I wouldn't consider myself as somebody who has substantial assets or anything like that, right? And of course, I've been tempted to make certain moves, but for me right now, my plan is just to stay invested in the stock market. Yes, like I have satellite positions in things like FLKR and Nokia. However, I am holding on really beefing those up right now. In case you don't know, with FLKR, that just tracks like the Korean economy. Of course, obviously, it's weighted very heavily into SK Hynix and Samsung. But what's also been happening there as well is getting interesting because Samsung's workers are threatening to go on strike because they want, a share of the insane profits that Samsung's been pulling in. And so because of that, obviously that can translate into massive amounts of losses very quickly for Samsung. And so it remains to be seen what's going to happen with that situation. But, even if in my mind, the courts decide that, hey, the workers can't go on strike, right? It still just creates uncertainty because you don't know what that's going to spill over into later, right? And so that's already on top of the fact that, AI just in general seems to be very heavily weighted towards semiconductors because it's one of the, several constraints, in terms of expanding AI. But we'll see. So right now, I'm not really aggressively growing those. I'm just staying true to my VTSAX contributions for now, and just trying to stay disciplined with the investing as things stand. I think like if I had substantially more capital, I could see situations where I would probably invest more into things like certain bonds and such, just because the yields on those are starting to rapidly increase. And because of that, right, the US government is the safest, not sure what you would call it, I guess investment there is, right? Supposedly, quote unquote, so I can see a situation where those start to become, more attractive, but then at the same time, maybe not, because our fiscal situation is getting increasingly worse, right? Our total debt situation is getting increasingly worse. China's starting to dump our bonds and, reduce their total holdings. So it makes you wonder, like, what's going to happen with all that as well. So again, I guess like the theme right now is just uncertainty. And so I think it's worth talking about because these next few weeks could get very interesting, just depending on what happens. So yeah, I just thought I'd make a video on this because, it's a very weird time, y'all. And I wish I had a better way to explain it, but for me, it just feels like there's so many factors just kind of conflating on each other right now that it kind of makes it hard to know like exactly what you should do or how you should prepare, because like gas is already going up, food is already going up, electricity is already going up, but at the same time, you can only control what you can, right? So, where things stand right now, in case you missed my last video, I'm shoring up my emergency fund again, just in case, who knows. And then also just sticking with my Vanguard total stock market. If my portfolio was a bit larger, I'd probably make some other investments as well. But for now, as things grow, just trying to stay disciplined and to keep things tight. So, yep, that's just my thoughts for today. And we'll see where things go from here. All right, peace.